Hello classmates, this is my video tutorial about Chapter 3 Exercise 5. Here in the Wally Plus system we are tested how to record the financial transactions, and we have a tabular analysis of the transactions made during August 2017 by Columber Company during its first month of corporation. So here we are given as many information. Here is the table with 9 items for cash, 10 items total, and we are given the test to analyze and to put into T accounts all the transactions made during the month and see how we are able to record the financial transactions of this company. I have been working in advance with the T accounts in order to save some time, because after we have made these transactions, we need to go to see the 3 financial statements. So in the cash account we see there is 9 transactions during the whole month. Those right here you can see we have $17,900 going into the company as a positive value. Right after we have a negative 1,770, which means that the money goes out from the company. It could be a payment to a supplier or even a stakeholder equity. So in the T account we recorded the debits or money going into the company in the left side of the account, and credits or money going out from the company goes in the right side of the account. I guess that's why credit cards are called in that way. It means you're losing money. So the 9 items I recorded into the account, and we have the final balance of $4,030 as money cash in the company. All of those transactions recorded here are credits, money going out from the company, and those 3 are money going into the company, are debits. So we also repeat the same steps with the other accounts. With accounts receivable, we have 5,500 money going into the account, and this 440 it's money that already were paid, so it's discounted from the total. So our new balance is 5,060. With supplies and equipment, there's only 1 transaction, and it's recorded as debit because it's in favor to our company. And in liabilities, we have only accounts payable, which have very few transactions. It's important to mention that liabilities works in opposite way to assets. So it means that when money is going into the company, it's recorded not into the left, it's recorded in the right side of the account. So the debits are changed for liabilities and also for the stockholders accounts, as in this case is common stock. So those accounts works in opposite way to assets. And going back to the exercise, we can see that the same financial transactions are reflected into our whiteboard. Having all of the transactions recorded in the right account, we proceed to go to make the financial statements. First, we have our income statement. This income statement reflects how much money have left into the company after the operation. It means that it's total revenue less expenses. This is only for the operation of the company. So explaining the income statement, we have service revenue, $10,000, which are given in the stockholders' equity. We have $10,000 revenue, and our expenses are rent, salaries and wages, and utilities, with the amount also given in the stockholders' equity. You have the explanation and the amount right in this place, and adding those three transactions, we got a total expenses of $3,270. So net income is our total revenue less our expenses from the company operations. In this case, we subtract from the initial $10,000 the $3,270, giving us a net income of $6,730, which means that our revenues have exceeded our expenses. Net income is a base for our next statement, financial statement to the company, which is retained earnings statements. This is part of the owners, the stockholders. And for August, we are given information that there's no retained earning, so we place a 0 into the statement. It's the first value we record. We add the net income, which we take from the last income statement. We know that it's 6,730, and it becomes our new balance. To this balance, we are subtract dividends paid to stockholders, which is $1,600, and our new balance for retained earnings to the end of August, it's $5,130. So, having the retained earnings up to date, we move to the balance sheet, which is the last income statement and the screenshot of our company. We can see by our income, by our balance sheet, how good a company is doing. Here we are going to use most of the accounts we already did, and we are going to classify according to the liquidity. It means how easy it's an account to make money. We are going to place this information into the balance sheet. So we start with current assets as liquidity. We have cash, accounts receivable, supplies, with the amounts we already have in our T accounts. We have the balance of $4,030 for cash, or IRR 5,060. Supplies, we have 730, and equipment is 4,970. We place those values into the balance sheet, and we first got the balance for current assets. Our total current assets have a value of 19,820. We add the equipment balance 4,970, having a current total assets of 24,790. So this is our total company acquisitions, and we are going to move next to liabilities and stockholders' equity. Here we have a few accounts. In liabilities, we only have the account payable, which is composed by 3 financial transactions, having a total balance of 1,760. We move to the balance sheet and fill out the space with $1,760. Then we move to the stockholders' equity. We have common stock, which are given in the first part of the exercise. We have a common stock of 7,900 right here. So we move this information into our balance sheet, and next we place the retained earnings up to date that we already did in the retained earnings statements. That's the value we place, and we have a total stockholders' equity of $23,030. So, as you remember, our balance sheet have 2 parts. In liabilities and stockholder must equal assets. So as we have assets of 24,780, we add the total liabilities with stockholders' equity, and we get as a result 24,790, exactly the same as our total assets. So our balance sheet is done, complete, and right. Thanks for watching, and have a good day.